Hello, my name is Bryce, from Apollo IQ. I will be hosting this presentation on behalf of Scott Shelley, the CEO of Apollo IQ and Apollo Risk Management, and the creator of the Apollo IQ TeleWealth Employee Benefit Program, a program built specifically for the retirement plan participant. I welcome you to this strategy session. Today's Risk Management Masterclass session is going to focus on the Target Date Fund. Those highly promoted, often selected, done-for-you asset allocation funds, from Vanguard, Fidelity, BlackRock, John Hancock, they are in every plan in America. By the end of this presentation, you will have a deep understanding of what target date funds are, how they are designed, the methodology used to allocate your retirement savings, and how Wall Street's diversification strategy has performed for 401k plan investors compared to the US stock market over the past several market cycles. Today's presentation is for education purposes only. Nothing discussed should be taken as personal, investment, tax, or legal advice. Past performance is not a guarantee of future results, and our examples are for illustrative purposes only and not personalized recommendations. Before we begin, let's clarify that no one sets out investing for retirement with the intention of earning only a small fraction of what the stock market returns. Yet this is exactly what is happening to plan participants in nearly every plan in America. Participants trusting Wall Street's experts at Vanguard or Fidelity or John Hancock to properly manage their retirement investments and financial futures, only to learn the hard way that Wall Street's diversification strategy has only captured a small fraction of the S&P 500 stock market returns over the past 5 to 20 years. Most target date funds underperformed the S&P by 60 to 90%. Yet few participants are disclosed those facts when they are enrolling in the plan and choose those funds. Instead, they are conned into target date funds as a good professionally managed option. The most unfortunate part is that according to the investment company Institute, 61 to 77% of retirement plan participants are using target date funds and asset allocation funds in their 401k to save for retirement. Target date funds are what are known as funds of funds. One mutual fund, holding 10 to 20 additional funds inside. They hold a collection of all global asset classes, all the time. The typical target date fund will ultimately hold 15,000 to 25,000 different investment positions collectively. It's this over-diversification that is the greatest killer of portfolio returns. The methodology used to build these funds is called glide path portfolio construction. A non-flexible, predetermined, global asset allocation strategy. Wall Street's gift for Main Street's 401k investors. Little do participants know that every Wall Street firm managing target date funds uses the same glide path theory to construct portfolios. The portfolio's allocation automatically adjusting with age. The theory relies on global diversification across every asset class, everywhere, all the time. Rather than investing in the positions with highest probability of success, glide path construction holds a minimum amount of U.S. equities as a strategy, then continues to minimize the amount of U.S. equity exposure in the portfolio as the investor gets older. Glide path portfolio construction prioritizes global diversification, with zero consideration for end result. Zero consideration given to market, geopolitical or economic conditions. The results of this investment strategy over the past 30 years of target date funds living in Americans' retirement accounts. Pre-retirees are now in a panic according to JP Morgan. They don't have enough saved and 64% are scared of running out of money during retirement after capturing pathetically low returns in their 401k over the past decade. Wall Street's professional money managers have failed to deliver for Main Street investors. Glide path theory minimizes exposure to domestic U.S. equities, instead expanding the portfolio's risk globally, adding other asset classes with minimal to no possibility to provide the investor with an acceptable market cycle return. Making 1 or 2% on retirement savings should never be acceptable, let alone intentional. The failure of target date funds lay in methodology. Own everything everywhere regardless of fundamentals, regardless of economic, market, geopolitical or interest rate environments. Bad strategies lead to bad results. The results of glide path theory, removing the U.S. equity exposure and growth assets from retirement portfolios during working years, has had grave consequences. The average participant very well may have experienced over $1 million in lost opportunity in their portfolio before reaching retirement. For some reason, the experts in Wall Street don't believe 500 companies is enough diversification for unsophisticated plan participant investors. And regardless of which Wall Street firm target date fund you use, the outcomes have been poor at best. Best-in-class professional TDF management captured only 19.5% of the S&P 500 market gains through this past 15-year market cycle. That was their best. If Wall Street's best just isn't good enough for you, maybe it's time to discover a better way. Stop allowing Wall Street's flawed theory and poor management to derail your retirement happiness. Instead, we welcome you to Apollo IQ, where our intelligence can quantify into your wealth creation. At Apollo, we believe in a formula-based approach, where better math can deliver better outcomes. We believe in a rules-based framework to construct portfolios, the same framework strategy that has consistently allowed the S&P 500 to deliver solid returns for most of its 150-year history. This approach has shown that solid math has a higher probability of delivering higher success. We believe it is best to test a formula backwards, to ensure it has worked in the storms, than test a theory forward and gamble your fortune and future on maybe. We have discovered, through studying the data, that rules-based portfolio construction can protect a participant from experiencing large market drawdowns and losses during the storms. A result of a disciplined approach to owning the right investments at the right times. Apollo IQ has sourced a series of rules-based model portfolios for participant use within their 401k. Each portfolio strategy has shown to dramatically minimize drawdown losses during historic market crashes. At Apollo IQ, we believe you do not have to compromise the ability to grow your portfolio for the desire to protect it from loss. Both can be achieved symbiotically, and we would like to show you how. If you'd like to avoid the $1 million target date fund mistake, use the link below to book a call with our team, and let's discuss how rules-based constructed portfolio can help you achieve your retirement dreams.